Well, before I bring Warren to stage, I'll just tell you a little bit about him. Some of you may be very familiar with him and some of you may not. He's one of the quirkier characters we have here at 21st Century. He's been known to get on the piano late at night, and he's actually very good at it. So any of you that were on the Caribbean trip, was there anyone on the Caribbean trip? No? Warren apparently, what's the term, pianoed up a storm? I don't know how else to pronounce it. Yeah. Anyway, he got the crowd going. But he's a qualified tax accountant and tax lawyer. He's been in the industry for over 20 years. He loves helping people slash their own personal tax. He's got so many little tricks up his sleeve, it's not funny. So, he's not only qualified to speak on tax in Australia, but also very experienced in international tax. That's why we obviously have him here. So, without further ado, we'll get him up here. So make him welcome as he comes to stage, Mr. Warren Black. Come on, guys, give it up for Warren.
Someone who does tax.
Well, how are you all? Isn't it great to be here in the US doing it this time?
Yes.
Let loose a bit, have a bit more of a personal atmosphere and all that? Shame there's no piano, isn't there? You could. There's one out there.
There's one out there.
The Caribbean cruise, I got up and sang Bryan Adams and some rock and roll and had a bit of fun. Tonight, maybe, yeah. I'll do it tonight. Who wants me to do it tonight? Well, if you get the piano organised, get me permission, I'll do it. Special recital and no extra charge. Well, you're learning some great stuff about US property, eh? Who's excited?
Yes.
Who's ready to really get into the international investing area, start building some wealth and start getting all that? Well, one of the things in doing that, of course, it's all great, owning property, but what do we have to face in real life? Tax. Yeah, I mean, and not just that, people who want to steal what you've got. So not just governments, but sue your ass. So I'm here to save your ass. See? To keep the taxman happy and keeping your ass safe at all times. So that's what I'm here to do today. Those of you who's heard me speak at a 4-day event? Yeah, I'm known for being a bit provocative. I mean, I'm a big believer in, look, the system that we're in, all this, and basically break the status quo. That's why you're investing here. I'm the same with tax and asset protection. I mean, if you do what the masses do, what do you get? That's right. So I'm a big believer in always finding creative ways, looking at ways to do it, looking at the best ways, always staying one step ahead of the game. So today I'm going to go a bit more into depth in terms of what I normally do at the 4-day events. I'm going to possibly cover, depending on time, a little bit about more about offshore, just mention a few comments that I normally wouldn't mention Australia. Who would like that? Yeah. Things like that. So, okay, let's just do a bit of background about myself. I'm a lawyer, and that's why you can trust me. I'm an accountant, which makes me even more trustworthy. And what else? Oh. And a financial planner, even more trustworthy. So I've got a few little degrees there. I mean, I thought I was pretty bad having 3 degrees, having no life, but my business partner has 16 degrees. 16 qualifications, I'm not kidding. 16, so there you go, I'm pretty tame in comparison. And I put part-time psychic, some of those who know my... That's a photo of me in my earlier years. Okay. So, experience as a lawyer, accountant, financial planner, 10 years working for the dark side, and now come to convert you all to salvation, to the light. I've been working for 12 years since my days in the dark side as an accountant and lawyer, and I'm here to get you out. And I've put them into wealth creation structures, mindset, quantum physics, part-time psychic. There you go. Okay, a bit of intro to my family. I've got 4 boys, keep me busy. It's my son William. He's just turned 10, one day after me. That's my twins, James and Edward. My youngest, Josiah. And that's Grace, one of my children. I put Mother, we're actually separated, but still a very important part of my life. Okay, so what are we covering today? So 3 main topics. Firstly, how to keep the ATO at bay. Who wants to know that? Believe me, governments can cause you more hassles and more headaches if you don't comply than anyone else. So I'm covering a bit about offshore today, how the tax system works. I'm not going to go a lot into US because there's some guys speaking tomorrow who are going to cover a little bit more detail on that. I'm going to talk about why structuring and how to structure and why you should structure certain ways. There's a lot of propaganda going around the academy on this US property, and I've heard that many stories just coming back to me as to doing it this way. I'm going to tell you the facts as to how it works for self-managed super, using trust. Who wants to know this kind of stuff? Yes, so these are the facts. This is not just my opinion, it's the research as well as talking with super fund auditors and others. So this is the deal today. And using your super fund, how to build good retirement wealth and do it in a compliant way. Okay. Now the failed solution, look, the great thing about you being here is you're really here to be educated and get one step ahead. So the purpose today is to say to you, I'm here to educate you. You use advisors to help you, just like you're using US property experts to help you buy property, right? But you're not just passively or blindly relying on anyone, are you? You're doing a bit of your own due diligence and research, yep. So my aim today is you need to know as an investor, professional investor, the basics of tax, asset protection, how this all works so you know what's going on. Okay, so the aim today is to educate you. The successful solution, the failed one is what I call blind trust. The successful one is learning how the law works for yourself, practicing what you learn and using advisors to support you. The great thing is that there's so many different things you can do. And why I say about learning, I've learnt the hard way what happens when you blindly trust other people. Who's had some really severe lessons in their life by blind trust? Yes. I suffered some very bad health crisis years ago because I had blind trust in doctors and got worse. And when I finally went and researched health for myself, I got better. So I know what that's like. I relied for years involved in the church and got really nowhere until I went and studied my own stuff on spirituality and moved forward. So likewise, to be wealthy and build property wealth, one, you've got to make sure you know what to buy, which is what Jamie and the team is teaching you here. You need guys like Goro in terms of getting the money, the capital available to make sure you can maximise and buy as much as you can. And you need to know how to structure yourself, not just what people tell you, so you keep basically scumbags far away from your property, so you keep them yourself. And remember, everything you hear in Australia about lawsuits, in US is multiplied quite a bit more, okay? So lawsuits happen here, it's a business. I mean, there's guys who actually drive around in ambulances and hang out in street corners waiting for smashes so they can run around and get their business cards. Literally called the ambulance chasers. There's people here who make their living from suing people because they know it's very profitable. There's law firms who actually work out the probability and success rate of actually lawsuits in particular areas. They then offer basically no win, no fee. They take like 30 or 40% of the winnings if you actually win the lawsuit. And many law firms become multi-millionaires overnight just by winning lawsuits. So believe me, they have a very high incentive to win the case, and there's a very much this nanny lack of responsibility mentality. So very important that you know how to protect your assets on every level. Just because you live in Australia does not mean that you're safe in US. There's some quite remarkable laws in US, like the punitive damages award, for example, where you can be fined triple damages, which have got nothing to do with actual loss, but just to simply show the other party they're mongrels and deserve to be punished. Like triple damages. The US government actually believe, and we learnt this international law, that they can apply their law on foreigners when they want to, and they've tried to do this on many occasions. So just be aware of this kind of stuff. Okay. Keeping the ATO at bay. So if you're taking notes, I'd encourage you to do so here. Learn how it works, learn how residency works. Okay, tax is far too high, which I think we all unanimously agree. Okay, how tax works over here in US for you as an Australian. Okay? Now, this is a little bit of basic tax law I want to give you, which is, on the one hand, very basic, but you need to understand this, because I hear all kinds of weird and wonderful things. You're taxed on your income, and you can claim costs against your tax which relate to your income and aren't private, domestic, or capital in nature. Now, the fact is, whether you're an Australian resident or not, and you're doing business in the US, you have to pay tax in the US. And not just that, you have to pay tax in Australia, because an Australian resident will pay tax on their worldwide income, okay? So just going back to that slide. So the rule in Australia, in simple terms, is any income you make, which is rents coming in from the property, you are taxable on. Any costs which you have to spend to, like local taxes in the US, repairs on the property, maintenance costs, local water rates, anything, you can claim against it. Travel in relation to the property, all that kind of stuff, you can claim against it, which aren't what's called private, domestic or capital, which means they actually must in some way relate to the property. Capital, that's important to understand. Capital means that it's not really so much a repair or something related to the property, it's more like an improvement or structural. Classic example, you buy a US property and let's say that you just paint and you fix up a bad paint job because you buy a really crappy house in Phoenix, but it's only like 30 grand. You spend a bit of money to paint it and just at least make it look presentable. That's a repair, you can claim that. Now, let's say by contrast, you see a really crappy house, and I know Jamie said don't get too caught up in reno, but it's just so bad, but costs you like 10 grand or something. So if you spend, say, 5 grand redoing up a whole back room and making it, quite reasonable, you can't actually claim that against the property. Not as an outright deduction. You can only get what's called write-off because it's what's called capital, okay? So just understanding that capital basically means it's not so much an ongoing repair relating to something that's already happened, it's like a structural change or thing to the property, okay? Now, you pay tax at high marginal rates in Australia, and being offshore doesn't change that situation. So you're going to pay tax at high marginal rates. So putting it in simple terms, let's just say that you've got like an income in Australia of about 90k, for example. Let's say you buy a few US properties over here and you make a net rental return of an extra 30k. That gets added to your income and you pay tax in Australia. So let's say that you've got, that the marginal tax rate over 85k is about 40% plus Medicare of 1.5, so it's pretty high. So you'll pay about potentially about 12, 13k in tax on that. So obviously the more deductions you can claim, the better. Now, this does raise another question, which comes on the next slide. Residency. So the question is, you'll pay tax, US say, we've got to pay tax over here because it's a US property. Australia, however, say, oh, you've got to pay tax as well. So effectively, both governments want their slice of the pie. US say, well, even though you're not a resident of US, the property's making it over here, it's our land, you've got to pay tax to us. The Australian government say, well, the property isn't over here in Australia, doesn't matter, you belong to us because you're one of our little select few on our list, on our mailing list, one of our clients, so we want you to basically pay your dues to us. The question is, are you going to be paying tax twice? Now, what they've got in tax law, just a good thing to understand for any country where you're going to invest internationally, is what's called double tax treaties. So it's what's called the tiebreaker agreements. So if you end up paying tax twice in like 2 different countries, the tiebreaker agreements end up saying who's going to be paying tax. So for example, certain properties which you buy, capital gains tax may be paid in some countries, but in Australia they exempt it, not US unfortunately, but exempt it. So one country says, we'll waive our taxing rights, and this one, you waive your taxing rights on that one. Now, unfortunately, neither country has waived their taxing rights, so both countries want their tax slice. However, they do say you can claim a tax credit for what basically tax you pay in the US. So let's just say that for whatever reason you pay $9,000 in US taxes, okay, on the property. So what happens is, let's say that on $90,000 you pay like $22,000 tax, which is about right. You'll have $13,000 then, say, tax in Australia. So basically you still get taxed as normal. However, the US tax of 9 grand can be credited as a rebate against your tax, so you end up only paying like $26,000 in tax. Does that make sense? So unfortunately, you still pay the extra difference in Australia. You always paid a higher amount. That's how it works. So if the US taxes were higher than the Australian one, you get a full credit but no rebate. In terms of questions, I'm going to be opening up for questions during different parts. So just keep a note of. After different sections, I'll open it up for a few minutes. So that's all clear on that? Pretty straightforward? Piece of cake.
For you.
But yeah, so basically in simple terms, I think the easiest way without getting confused in an afternoon when you're probably still carrying your food is think of it this way. Whatever tax, when you get rental income on a property, on your tax return, you're going to be putting like net foreign income. You'll pay tax on that as per normal. But if you pay tax in the US as well, when you lodge your tax return, and the guys tomorrow will go through that, you get an offset against your tax to make it lower, so you don't pay tax twice. Is that clear? So if you'll understand that basically you won't pay tax twice, and if anyone tells you that, you can relax and say, no, that's not the case. Now, the next question is residency. That's reasonably straightforward. Most of you here will be a resident. If you live or reside in Australia, which means you've got a family home, you've got kids there, or you've got a regular home you've been living for years, you've got jobs there, you're a resident. However, there's also further tests. If you spend more than 6 months in Australia, you're still considered to be a resident unless the tax office is satisfied that you have what's called a permanent place of abode outside of Australia. Now, I've done lots of advice over the years on that. I've helped a lot of perpetual travellers. I've set people up. One of the things that people say to me, in light of Paul Hogan and all that, can you still pay no tax offshore? I said, well, much harder, but there's still ways. Recently, I set up a client who is willing to go and sell up his family home and travel around the world and live in Bermuda with a Virgin Islands company, pays no tax whatsoever, trades Forex and E-minis, pays absolutely no tax at all through Virgin Islands company. Who thinks that's pretty sexy? It's good, isn't it? So you can do things like that. He lives less than 6 months in Australia, so he's fine. He's got no base in Australia. Now, if, for example, he had more than 6 months in Australia, then he would be considered a resident unless he could show the tax office he has what's called a permanent place of abode. So let's just say he sets up, buys a home in Bermuda, puts a child in school, something like that, no problem. No issue whatsoever. A more difficult situation, as one of my clients had, he actually lived 9 months of the year in the UK, but his wife and children lived in Australia. So the tax office were trying to claim, but he was a resident of Australia, even though he was only 3 months of the year, because he had wife and kids in Australia. So I won't go too much into that. There's a 2-year rule, which the ATO used, that says if you leave Australia for 2 years or more, you'll be automatically deemed a resident, pretty much. So that can be quite useful. If you're ever thinking you want to go away for 2 years, you might go away for 2 years. You might generate as much income as you can through investing or trading or property or whatever else, pay no tax in Australia, and then go from there. Okay, so basically in summary though, for most of you here at this time, you'll be residents of Australia, you will pay tax in Australia. So work out your taxes carefully. One little point I'm going to mention, which might sound obvious, but I often have people say, I've actually heard a few clients say to me things like, oh, it's great, you know, I'm buying a US property for a tax break. Now, remember this, tax break basically means a negatively geared property. So if you buy a property that's worth, say, let's just say that you're making 20 grand in rent on an Australian property and you're paying 30K in expenses, just in interest and rates and taxes and everything else and costs, you're going to have a $10,000 negative gearing loss, which can offset against your day job income. Do you get that so far? Now, if in the US you make 30K in rent, for example, and only pay 15K in expenses and make a $15,000 income, is it going to reduce your tax or increase it? That's right. So you're not buying this for tax break, you're buying it basically for passive income, effectively. Again, self-explanatory, but there are ways to reduce your tax and get best results through using various structures. So just a little bit more on taxes on property, how it works. I mentioned here you pay tax on rent. You can claim deductions for expenses you incur in earning your rent. So in buying the property, so things like travel, repairs and maintenance, depreciation, managing agent fees, building write-off, and I've mentioned you can't claim capital expenses. There's also various other taxes on property in the US to be aware about. Local taxes, but again, the guys tomorrow will go through and that gets generally taken care of by then. But also capital gains tax. So when you sell the property in the US, you're going to have to pay a light capital gains tax on the sale of the property. So you'll pay it in US and you'll pay it in Australia. So in summary, if you earn on your rental income, you'll pay tax. Your local taxes, you'll pay taxes on the sale of the property. As they say, the only two things certain in life are death and taxes. Now, in terms of Kiwis, there's a few Kiwis here. Yes. Sorry, I couldn't resist. Sorry. So for Kiwis, there's actually a handout which is available. Put your hand up for your Kiwi, because there's a special handout for you. The rules are pretty similar, mind you. Just keep your hand up for your Kiwi, if you're part of the sheep brigade. Okay, a couple more here. I've mentioned here that the salient points for Kiwis, which I won't go too much into, but just have a read about companies and trust, the difference there. Generally, owning your US LLC in a company is not a good idea. You should own your shares through a New Zealand trust. That's probably the main point that comes out of that. The rest of it's very similar. So, okay. So we covered taxes. Now, before I move on to structuring, now I'm going to open up just for a few questions on this. You have one over there? So I've got 3 sections, and I will take questions quickly after each section.
For an Australian tax resident,
Yep.
if you don't remit offshore income back into Australia, is it still taxable?
It depends. I'm going through that a little bit more later on. It's a very good question. You've got these laws called controlled foreign company laws and foreign investment fund laws and that. So it depends how you structure it, is a short answer. And when I go through structuring, I will cover that a bit more. But it's a good question. Anyone else?
The rollover provision with the US capital gains tax.
So?
The rollover
Yes.
position for the US capital gains tax.
Yes.
So if you put the money into another property within 6 months,
You can roll it over, yes.
yes, so you're not paying any capital gains tax,
Correct.
but then would you be then taxed on that
In Australia.
as Australian capital gains tax?
Oh, absolutely. Australia don't have a rollover, unfortunately.
No, yeah, okay.
Yeah. We're a wonderful country, Australia.
Just regarding self-managed super funds
I'm covering that in the third part.
and the expenses you mentioned earlier on,
Yep.
are the expenses the same, including travel expenses to look at your property?
Pretty much, yeah. I'm covering super in some depth a bit later on, because a lot of people are doing super at the moment. Anyone else?
Just one question. You said that's the 22K on 90,000 purchase is roughly about that type of number. What actual tax is that?
I haven't calculated exactly.
No, what
Oh,
is the
income tax.
Income tax.
Income tax, yes.
Okay.
Yep. Ah, someone else. Rachel?
Can you get a credit for the US capital gain? And if you held the property for more than 12 months,
Yes.
like say you paid 30,000 capital gain in the US, do you get, and I mean you get the 50% deduction,
Yep.
so then you owe 15,000 Australian tax. So do you get the a credit then for the
Yes.
30,000 you paid? So
Yeah, but you won't get a rebate. So what it means is, let's say that your US tax was 30 grand capital gains. Your Australia's only 15 because you've got some at that. You'll get a credit up to the amount of tax you paid in Australia. So you won't get the Australian government won't give you a generous little gift to make up for the US. Is that what you meant?
yeah, so you don't
Yeah.
pay any extra, but you
No.
don't get the credit to reduce
They'll never give it
any
to you,
other
no.
capital gain. Yeah.
The simple rule is, put it this way, and this is like, do you think the different governments want you to pay as much tax as you can or as little tax as you can? Okay, so the rule is basically whatever is the higher amount is what you'll pay. They'll never give you back a rebate for someone else's tax you paid more. So if in US you would have paid tax higher, you'll pay more tax in US. If Australia would have paid higher, you'll pay more in Australia. Basically, it's whoever gets the highest amount, like an auction, that's how it works. Anyone else? Okay, let's move on to structuring if that's no further questions. Okay. It's a big issue, asset protection, and the more time goes on with me, the more conviction I get about this, because when you experience stuff yourself, in the last few years I've had a lot more experiences myself with potential lawsuits, one actual lawsuit, issues with one company I had, and only being saved from a very bad situation because I was extremely well structured. I'm more and more passionate about this, that this is probably the most important insurance policy you're ever going to get. I'm not kidding. And I'll show it to you this simply. How many of you here own a car in Australia? Put your hand up. Okay, keep your hand up if you do not have car insurance. If you do not and you own a car. Okay, there's 2 people. Are your cars worth more than 10 grand? They are? So you got a car worth more than 10 grand and it's not insured? No. Okay, you're rare. No. Yep, you're one of the 1 in 20,000. But generally, what happens is the only reason people will not insure their car is because what? It's not worth it. I mean, people weigh up the risk and say, look, well, car's only worth 4 grand. I mean, if I write my car off, it'll be a nuisance, but I can afford to pay 4 grand for another car. Let's say you got a car worth 50 grand and you got hire purchase or finance lease or something on it. Now, if you write off the car without insurance, what does that mean is going to happen to the finance company? They're not going to be too happy and they'll be after you for the money. So as well as buying a new car, you have to sort out the finance company as well. So it's a no-brainer to basically get this car insurance. You all agree? We get car insurance because we want to protect ourselves from what? Loss. Paying out money which we don't anticipate. Correct? Yes. Okay. Anyone here got health insurance, like HBF or Medicare? Okay, a lot of you. Okay, keep your hand up if you expect to get a serious illness very shortly. No one? Put your hand up if you know you're going to get cancer in the next 3 months. No one. Okay, yet a lot of you insured in relation to a situation. Why? Just in case, to cover the cost in case you get something catastrophic or astronomical. Okay. How many of you know beyond a shadow of a doubt you have all your net worth completely insured? Put your hand up. 1, 2, 3, a few people. Okay, so somebody sued you tomorrow, is what the question is. You know that your assets can't be touched. Put your hand up. Okay, there's a few of you. So the rest of you, basically you're quite comfortable losing your whole fortune, am I right? No. No. You're not? Not comfortable. Who here is in business and does a sole trader? Anyone? Your sole trader partnership? Yeah, a couple of people. Yeah, you're probably the most vulnerable people imaginable. I mean, if you're actually a business and you're a sole trader, you get sued. This is what happens to you, okay? This is practical stuff and some of the stuff I went to in a Caribbean cruise. And I experienced a bit of this myself because I was well structured. Let's say that you're running a business and somebody sues you, or something goes wrong in your business and suddenly you realise your bookkeeper hasn't done tax right and you suddenly owed $100,000 in back taxes you didn't realise. You are in trouble. The tax office will mercilessly hunt you down and they will not let up. And I can tell you now how they think because I've represented clients here. Even if you try and do a payment plan, they'll give you one. But if let's say you can't make a payment plan more than what they like, they'll shut you down. And they'll go to court, they'll apply for winding up order and they'll shut your business down and then they'll go for you personally for the money. Okay? And they will do it. And they will bankrupt you. So let's just say that you're running a business in your own name, you get sued or something goes wrong with a debt which you can't pay, you will not only lose your business, your credit rating will be stuffed for buying future properties. If you go bankrupt, you've been for 3 years, you basically can't travel or unless you get permission. Next 7 years, your loans will either not be available or at a very, very high interest rate. You can't be company director, whole heap of stuff. By contrast, if you have a corporate structure or trust, and let's say you go broke in your small business, all that happens is a company gets shut down, the group tax is automatically wiped. All ATO debts are wiped without any recourse to you personally. Your credit rating remains intact. You can go out and get loans as if nothing has happened. Who thinks that's pretty sexy? Who thinks that's a no-brainer? Okay. So if you're in business, it is the biggest no-brainer in the world to get yourself a structure immediately. Immediately. Okay? It's a bit like you saying that you're planning to have kids soon and then you say, oh, I don't have any health insurance, but I'm hoping the health insurer will cover me. It's a bit like that. I mean, you just do not run a business without being properly structured. I can't say it strongly enough. I see catastrophic results. I mean, horrendous results. I mean, I had a client recently who he basically, was a couple of clients. One who was 55 years of age, had spent 35 years as a financial advisor building up their net worth, had $3 million net worth, had a reasonable income, ready to retire in super. One day, in his business, he made one error of judgment. He got involved in a very good investment offshore that was making such high returns, he started telling some of his good clients about this investment. But it wasn't on the approved list by the insurers. But he said, look, I mean, insurers are just, really, conservative. This is a good investment. I can't officially recommend it to you, but but have a look at it yourself. A number went into it for 10 years, made a whole lot of money. The whole thing suddenly went south and all of his clients lost all their money. I'm talking about millions of dollars. He came to see me. He was beside himself with his wife. I mean, literally distraught, because he realised he hadn't properly structured himself. And the problem was, when we went through it, it was pretty clear the insurer would not cover him, because the insurer was like, you have gone outside the policy. So he could be sued for millions of dollars of losses, and he would have been personally liable and lost everything. His wife was literally beside herself. 6 months later, his wife actually left him because of the stress. Okay? This is true story. When you're not structured properly and your finances at risk, believe me, marriages break down because of it. Relationships break down for money more than any other reason. So structuring yourself properly doesn't just ensure your security, it ensures your relationship. I mean, be honest. Who here's in a relationship right now? Who knows that if you lost everything, it would cause some stress in your relationship? Pretty much most of you. It does. So this is, believe me, I say to people, it's a cost of business. Whatever traditional accountants have told you, whatever has told you, listen to this very carefully. This is as absolutely critically important how you keep your money, and the rich know this as much as it is making your money. You're getting what I'm saying there? If you get sued, or if the tax office comes after you for an unpaid debt, and this happens more often than you can think, you will, and you do lose everything, your credit rating's gone for getting wealth. You're basically either going to be out of the game or going to have to go through all kinds of rigmaroles to get back into the game to buy property. Good chance your marriage or relationship will break down or get into serious trouble. So simple little things like structuring yourself and paying not a high amount of money to insure it. And the good thing about structuring is unlike car insurance, you pay $1,000 each year, you're paying a one-off cost, and pretty much, apart from a very small ongoing ASIC fee and tax return fee, your costs are very minimal to insure your wealth. Okay, so who here now realising that you've got to insure your wealth a little bit better than you have? Okay, good. So the fear of losing assets, it doesn't just also affect your marriages and your wealth and everything else, it affects your creativity. Now, put your hand up if you've ever had serious money stresses. Okay. Have you found your ability to think creative has gone down in that time? No. Massively? Yes, when you've got serious money stresses, you start finding it hard to think straight. So part of emotional management they teach you in psychology is the ability to structure yourself in your emotional being. I mean, I've just been through a very brilliant course myself in the last 6 months on emotional management, because I tend to be pretty out there, as you noticed. I'm musician, I'm artist, I'm very creative sort of a guy. I tend to have mood fluctuations by nature because I'm so out there. So I actually did a lot of courses myself on emotional management and improved significantly, and part of what I learned was structuring my emotions a lot better by certain techniques I do daily, certain things I do, which has made like a radical difference to my ability to maintain focus and not lose concentration. So similarly with your wealth, you want to be putting in a good structure in place to ensure that your money stays fairly smooth. And if someone's suing you, they're not going to get your assets, period. Or they're going to have to go through one heck of a fight with you to even get close. So stress really undermines creativity. I'm here to save your ass, basically. So now, this is a bit of humour in the way. These are some of the slogans now being used. You see on these things. Do not eat on Apple iPods, on some of the ones in America, to protect against lawsuits. Probably one of my favourites is this costume is not suitable for flying, because kids have actually put on Superman costumes and jumped off roofs. Just thinking their Superman got injured when the parents have actually sued the maker of the Superman costume.
The hand dryer's up in the room, so do not use and shower.
Yeah. Yeah, one of my, a local council in Australia, in Cottesloe, there were some signs, there's small rocks there saying, do not dive from the rocks head first into the rock, or something like that. Because of a lawsuit thing that happened about 5 years ago in Cottesloe Council. I mean, it's nuts. I mean, this product is not, oh, hang on. This product is not intended for use as a dental drill, an electric rotary tool. And on a hairdryer, do not use while sleeping, is one we saw.
Second last one, they could maybe end up a brain surgeon.
They could do. Yeah. In fact, on that issue of the Superman costume, true story, my cousin, when he was 5, watched Mary Poppins. Who remembers that one? You know he jumps off the umbrella? My cousin got an umbrella, climbed on the roof and jumped off with the umbrella, went and actually injured his leg quite badly and was off kidney for a while. So this is how lawsuits work. Lawyers search the asset registers to see if it's worth suing you, okay? If they don't see any assets or they see your assets are well protected, they will go away. And trust me, I'm speaking as a lawyer who, when I used to work in a law firm, people would come to me, and if we could see they were well structured, don't even bother. One of my clients last year actually came up and insisted on giving a testimonial for me at a seminar because he said, just simply listening to what I told him there saved his house. He got sued by his business partner, lost a whole lot of money. But the one thing he tended to ignore most of what I said to him because he didn't want to pay him money. He's a real tight ass with money. But after a lot of insistence, he put his family home in a trust. The trustee in bankruptcy turned up to take his house and he said, it's not my house, it belongs to the trust. That was it, never heard from him again. Kept his house. So, believe me, these things keep your assets, save your life. Why do you think Alan Bond and all these guys, when they went bankrupt, continued to go on as normal? So, what I call it this way, it's your get out of jail free card. Who likes Monopoly here? Yeah, your structure is your get out of jail free card. So let's just say that you go into business. I mean, most business people, generally by the time they're 40, who are entrepreneurs, have had at least 2 failures. That's fairly common. And Jamie would tell you some of his failures. I could tell you some of mine. All of us could tell you of horrendous mistakes we've made. The good thing about correct structuring is it gives you another chance. If something goes wrong, you can start again. My structuring saved me in some of my horrendous blunders and enabled me just to get back on my feet and move on quite quickly compared to what I should have. You can tell them where to go if you're structured properly. Asset protection is about creating hedges. Now, what I mean by that is this. No structure of anything is guaranteed only because the government can change the law as and when they want. Who's learnt that one? But the harder you make it, the less likely you're going to be sued, okay? I'm telling you, in practical terms, it's like, I know when I've helped clients when they've actually gone broke, and one client had to liquidate his company. And I pretty much told him, I said, you know, the sad thing I said to this client was, if you wanted to, it's so easy to be a crook in Australia with a system. It actually is really easy. I mean, if I wanted to, I could be a very successful criminal, which I'm not, I can assure you. But there's a lot, the way the system works, ASIC really don't give a fig in terms of, say, when you're winding up a business. Although we're meant to investigate you for insolvent trading, they actually don't. They put their resources into getting PR. Now, ASIC are more concerned about having a media image that shows they're doing something because everyone's always criticising them. Now, ASIC therefore put most of their resources into chasing big guys and others to make an example of them. So when ASIC gets a whole lot of reports from liquidators about companies, the guys just look at them, check if the toilet paper stock's basically low and then just use it for that. Well, not really, but the point I'm making is that they don't actually really read them or do anything about them. So pretty much, if you're structured properly and you've got to wind up your business, you can wind it up, move on, and just get on with life, as a general rule, okay? And not just that, but when people come looking at your asset register and they do searches on you, if they see that your assets are owned by wife, husband, family trust, I've told clients who've been seriously aggrieved and who wanted to absolutely sue someone, I've just said to them, have you got $300,000 starting capital to even begin this? Because not only are you going to have to sue them, you're going to have to do clawbacks on the trusts, you're going to have to go through Supreme Court equity litigation, and you've only got about a 50% chance of winning this case. And the client just goes, I'll just get on with my life. I describe it a bit like a car thief who goes into a car park and he's looking for a car to steal. And if he sees a car which has got really good alarm system, one that doesn't have any alarm system, which one's he most likely to have a crack at? Yeah, that's right. So, pretty clear? I mean, lawsuits are huge in Australia. It's even bigger in US. The LLC is a must to keep your assets safe and separate you. Governments also, they're very, very big. Many of the major lawsuits are shutting down are basically from governments like IRS. IRS are huge over here in terms of shutting people down or taking action against people. One of the things I've known happen to people, but IRS often, when they're low on revenue, will just actually hit people with a tax bill they know is deliberately too high, and this is what I've been told, and then basically they'll negotiate a settlement that will end up being the tax that should have been paid. In other words, to stop people complaining. Tax Office Australia, I've heard similar things. So in other words, governments, not saying all factions, but the reality is things do happen. You've got to be well protected. And people, of course, want to sue you as well. So let's have a look at the type of structures you can use to go about and protect yourself. Okay, the obvious starting point is just individual name. You just buy the property in your own name. Okay? Very simple, straightforward, lowest cost way of doing it. What's the problem with that? You're vulnerable in every sense, aren't you? If you get sued, who's in trouble? Yes. And trust me, in the US, if you buy it in your own name, for example, or anywhere else, well, in US especially, they can and they will take action against foreign debtors, get what's called a foreign judgment in a foreign court. So let's just say that they sue you in the US for whatever reason, they can come over to Australia and get a foreign judgment declared in the Supreme Court. The foreign judgment is enforced as if it was a US judgment. Your assets in Australia will get taken. Okay? So individual name is not a good idea. And if you're buying US property and running business especially, you want to make sure your assets are held in trust in Australia. Okay? And you're well structured in the US. Partnership. So that's where you buy it with somebody else in their name. So let's say me and my friend or you and your partner buy the property together. Anyone see a problem with a partnership?
Yes.
What?
When you want to get out, you have to buy your partner out.
Buy your partner out? Yep.
Yeah.
You're liable for your partnership jointly.
Got it. Jointly and severally liable. That's a biggie. Let's say, for example, that myself and say Steve, we went into partnership together and bought some properties, and something goes wrong, and there's a lawsuit. Well, basically, let's just say that Steve nicks off to Bermuda and gets a house there, which I'm sure he'd love, and they can't sue him. Well, basically, they'll go after me for everything that we've done together. And that's the same with anyone. So, if you go into partnership with anyone and someone nicks off, and you get sued, basically, you are liable for your partner's debts, business partner or anything else, okay? So, very important to avoid having a partnership. So, that leaves you with limited liability company and a family discretionary trust, okay? So, you've got a limited liability company in Australia, and you've got a limited liability company also in the US. Now, and you've also got what's called family trusts. Now, the way basically we're doing it over here, and the US guys are talking about tomorrow, and there's guys who we're working with here to help you set up your LLCs. So that the LLC is what you set up to buy the property, and that gives you protection. So to give you a bit of background why the LLC is so powerful, effectively it separates or isolates you So LLC isolates you from the risk. So let's just say that's you over here, and that's the LLC. So the property is owned by the LLC. So if somebody sues in relation to the property or income is paid, everything gets into the LLC, and you are basically kept separate from the LLC. Are you all following that? Yep. So it goes back to an ancient common law principle about the company. It's what's called piercing the corporate veil. So the LLC means that earns the income, that pays out to the shareholder of the LLC, which I'll be covering shortly as to who should be the shareholder of the LLC. And income gets paid into the shareholder by dividends or whatever else. Okay? So the LLC, everyone basically know how a company works. Anyone who doesn't know how a company really works? One person? Yeah, a couple of people. Yeah, very simply, a company has directors which run or manage the company, and you've got the shareholder. So directors can be, in certain situations, depending, personally liable, but not very common in a company. But usual rule is the company and the director is separate from a lawsuit. So if the lawsuit hits the company, the shareholder remains by and large safe. Is everyone following this so far? Yeah. Okay, good. A trust is another structural way of doing it. Now, I'm going to be covering trust a little bit more, so let me just keep moving through the slides on the trust here. I mentioned about partnership already, a company. I might add in Australia, there's a 30% tax on Australian companies, but we're talking mainly about US companies here. The guys from the US will go through this in more depth tomorrow on the US side. A family trust is the ability to split income and control. Now, US, again, we're focusing more on using a US company, but the question arises whether we should be using an Australian trust, for example, to own the LLC shares or an individual name. So in other words, for a trust being able to split income, my view is you basically generally should. So I'm going to go into that in a little bit more. So I've mentioned here about doing it as an individual, and the preferred method is through a US LLC. So here's the way you can own the LLC. There's 3 ways you can own it. Okay? Now, just be mindful, everything I'm speaking about here is assuming you're not using your super fund, okay? Your super fund is a different kettle of fish. So this is right now for all of you. Who's basically intending to buy property not through their super fund? Most of you? A lot of you. Who's going to be using the super fund? Anyone? Oh, a lot of people. Okay. Yep. So the super fund, keep in mind, everything I'm saying here is not how it works for a super fund. It's very different. Okay, so individual name. You've got this control foreign companies room. A gentleman over here asked a question here about, do you have to bring the money back in Australia and pay tax? The short answer is you've got these control foreign company rules that were brought in basically to stop guys like Kerry Packer and a whole lot of others from hiving off wealth offshore and not paying Australian tax. That was the theory behind it. Did it work? Not really. But by and large, that's what the control foreign company. So let's just say you've got a control foreign company here. So you've got LLC here, and you've got, say, Joe Bloggs owns the LLC, okay? So Joe Bloggs will basically, let's say that it earns a net income of $20,000 or $30,000 net from owning from the properties. That money, even if Joe Bloggs leaves it sitting in the US LLC, has to pay tax every year. It's deemed as if he's distributed it and he has to pay tax in Australia regardless of whether he pulls the money back in Australia or not. Okay, is that clear? Yes. Yeah. So even if you leave it offshore for 5 years, you've still got to bring money back in to pay your tax in Australia over there. That's what's called control foreign company. They're very complex rules, by the way, so I'm simplifying this quite dramatically, but that's how it works. Now, an Australian corporation is your other way of doing it. So rather than Joe Bloggs, you can do an LLC and you set up an Australian company. Now, the problem with an Australian company is, let's just say that you eventually, for whatever reasons, you sell the shares in the company or whatever else down the track, you'll end up paying twice as much capital gains tax as normal. Plus, it gets very complicated for dividends coming through an Australian company. It's not a good way to do it. You should not be owning investments like a US property company through that. You shouldn't be doing that. So you're better off to be using a trust. Not just that, but the family trust gets around that control foreign company issue, which I mentioned at the top there. Basically, until the money is brought into Australia, so only if a dividend is actually declared from the LLC and comes back into Australia, then tax is paid. Now, one little thing I'll mention here, and this is a little tip which happens to clients all the time, not just for property buying, but with just about anything, okay? It's how you write your forms up with governments on anything of a trust, which is going to apply here and everywhere. How many of you have actually found that a lot of the time when you've got to open accounts in a trust name, you'll notice that people say they won't do it? Anyone had the experience yet? So, for example, if you try and register a business name under a trust, they won't do it for you. So if you own a business name and you go, say, to the Fair Trading, they won't do it. They'll say, we won't do a trust. Some brokers are funny opening up a trading account in the name of a trust. PayPal won't do it. Yeah, exactly. There's a very simple way around that problem. You want to know it? What you do is this, and it's perfectly legal, okay? You basically buy a corporation or set up your corporation as a trustee for the trust. However, what you do is when you open your PayPal account, for example, open it in the name of the company only. Don't mention the trust. However, write up a trust minute and make sure it's signed and dated properly and registered in your minute book for the trust, but states that anything that this company purchases is only as trustee for the XYZ Trust. Okay. In the trust minute, it basically says anything that you do on behalf of this company, like let's say XYZ company, anything you do in this company, whether it's buy property, whether it's open a bank account, whether it's whatever, is only being done in its capacity as trustee for a trust. So it's only done in its capacity as a trustee for the trust. In other words, this is a shell blank company, but serves no other purpose for NAV.
So it doesn't become an asset of the company.
No, it's the company as trustee for the trust only. And that is perfectly fine. I've opened most of my bank accounts on that basis. I don't bring my trustee in. It's a nightmare. Who's actually found that when they've opened a family trust account, there's always more rigmarole and paperwork? Anyone? Yeah, if you just take a company folder and open it up, it's so simple. But just take the folder, look at a few things and do it. So I never bring my trustees in when I open up new bank accounts for a new trust. I just bring my company folder in and I have a minute on file. Who thinks that's quite cool? Works really well. It's saved clients of mine a lot of money with stamp duty. For example, I've had clients who've gone and bought property, for example, at auctions, and they've actually forgotten to basically put as trustee for the trust in the contract, but just put the name of the company, and they go, oh my gosh, they forget. But then I just say to them, it's fine, just do in a minute, straight away, provided that minute's done or whatever else, and it goes through, then the minute can say you're buying it as trustee for the trust, or whatever else. So anything in this company, if I've got a minute in place. So, for example, if you're buying US property over here and you set up your LLC, you can make an Australian company the shareholder of the LLC, but you have a minute back there saying that it's holding it in its capacity as trustee for a trust. You understand that? Yeah. So it can simplify things quite significantly. So my basic simple recommendation is that a general rule, and you've always got to get specific advice, but general rule is use an Australian family trust to own your US LLC. Is that pretty simple? Now, that does not apply for a self-managed super fund. That does not. And you're going to hear why. It's completely different how you set up your LLC if you're going to be buying it through a super fund. So, recommended option, as I said there, is buy the property in a US LLC. It works really well for asset protection. Have an Australian family trust as a 100% shareholder. And I've shown you precisely how you should be doing your purchase and having your trust minutes and all that. And for those of you wanting to do superannuation, it's great. I mean, superannuation is fantastic to be buying property. It's a great investment. It's a long-term, as Jamie said, you can't predict the US property market, but it's probably US really for capital growth is going to be more long-term. I couldn't think of really, without giving investment advice and very clearly making that one, buying investment property like in the US through a self-managed fund, it probably fits many of the criteria. It's a long-term investment. It's producing a positive cash flow, things like that. One other thing I'll mention before I move on to self-managed fund and before I start taking some more questions is succession planning. Now, this is quite important because I'm going to raise an issue with you that I suspect that most of you, if any of you, would even have thought about. Okay? Let's just say that, who's heard my presentations on bloodline wills before? Okay, very, very simply, if you're buying let's just say you buy a number of properties and you die. I'm just going to show you how it works. This is important to understand how the succession works because this can bite you really bad, okay? Let's say that you own 4 properties, or US, Australia, whatever. Or we'll first say Australia. Let's just say that you've got 4 kids. Anyone here got children? 4 kids? Oh. Same as me. Now, let's just say that you've got husband and wife. Husband and wife both die at the same time, or husband dies, then wife. So husband and wife die. Now, what will a normal will basically say? How will it go generally? Split equally? So basically each child is going to get 1/4 of the estate. Okay? You following that so far? Okay. Now, let's just say that the 4 properties, the kids are all sitting there around the table trying to work out who gets what. And they look at the terms of the will and they say, oh, yeah, we're getting it equally. And they say, well, we don't want to share 4 properties. Shall we sell them off? And they say, no, well, one of the kids says, well, look, I wouldn't mind having the house of mum and dad's over in, say, Brighton. And the other one says, yeah, well, I wouldn't mind the US property or whatever one. I wouldn't mind this. So the 4 kids end up splitting the properties each and saying, let's just take one each. And they shake hands on it. Sounds simple. Anyone see the problem in doing that? Sorry? Well, that's one. That's estate planning. The values are different, but that can be sorted by adjustments and mortgages. What's the bigger issue? Can anyone guess? Yeah. Transfer of ownership, which does what? Creates what? Stamp duty, and what else? What tax implications? Capital gains? Who said that? Capital gains. Because what's happened is each child has effectively sold off their interest in the properties to each other. So you're going to have capital gains tax and stamp duty. Not just that. Let's just say that one child, K1 for example, has got a business and has just gone broke. And he's bankrupt. Who's going to be getting his assets? The receiver, that's right. And finally, second child is just going through a painful divorce. Who's going to also get a share of their assets? The ex-partner, that's right. Do you know that with a bloodline will, all 3 of those outcomes can be avoided? Who's never heard of this before? Testamentary trust, 3-generational testamentary trust. It's a 3-generational testamentary trust or bloodline will. It can avoid all that. He thinks that's pretty cool. So it means that child 1 would keep their money. As soon as they're out of bankruptcy, their money's waiting for them. Child 2's ex-partner gets nothing. And they can move the properties between them and pay no tax. Who thinks that's a pretty good investment? Very, very good investment. But here's another issue as well, which you're going to all encounter here, which normally people wouldn't. Let's just say that, we'll use a single person this time. So let's say that you own 3 properties, or 4 properties. 2 are Australia, 1's US. Okay, what's the challenge you got straight away if you die? Yeah, that's not so much who's what. There's another issue. Oh, this is practical. Australian courts do what's called probate. Okay? When you die, you have what's called probate, which means it goes to the court. Probate means prove. It's a fancy lawyer's term that means proof. So proof of will. Prove that the will is legally valid. Once it goes through its proof through probate, that means that the will is certified, the assets get distributed. Now, let's say that the probate gets certified, the will is certified as okay. But go to the US people over there. What's likely to happen over there? No, US governments on these kind of things often with probate, believe me, it's a huge rigmarole to take a probate to a foreign government. They've even got to go through another certification process independently, can hold up the estate for I've seen up 2, 3, 4 years getting held up, going through different countries' probate. I have a client recently who was owed money from the UK from inheritance, it's taken 3 years, still hasn't got the money yet. Now, that could actually be quite easy fixed. Do you know how? You have a second will in the US. A second will. And that's more to keep the US government happy. So, you have your main will in Australia, okay, but how you get this done is critical. Because normally a new will automatically revokes the old will at law. So you get your Australian bloodline will set up. And you include everything. But then what you can do as well is have a second will in the US, which basically states that this will only applies to US assets which are owned and will not in any way, any shape or form, override or revoke your previous Australian will, except to the extent of where it's inconsistent for US purposes, okay? And what that will mean is that, let's say that I die tomorrow, my estate can go through one Australian probate at the same time, but I can get straight onto US probate with a US understood document, which won't have to go through someone who will think, oh gosh, this is too hard. And the process goes much smoother. Who thinks that's pretty cool? So you really want to be also, if you're going to be getting into US property, getting your succession planning sorted out. Because believe me, that is an absolute nightmare. I've seen people die. But when they set up offshore investments, the last thing they think about is succession. And also making sure who knows who's got what properties. I mean, let's just say, for example, that you died tomorrow, for example, and you own 3 US properties. Who knows that their people or loved ones would struggle to work out what's going on? I think a lot of you, wouldn't you? So can you see why that part of this structuring is getting your succession planning like spot on? So you want to make sure that you sort this will out. If you're going to be buying a few US properties, you're going to be wanting to do that. And that's, of course, something we can help you with, but making sure you get the whole package sorted out. Okay, I've covered a lot of things there. That was, I know, pretty in-depth. I'm going to open up for questions now. Who's got some questions?
If you sell the properties and then within 2-year period, don't you then avoid the capital gains tax?
What's this for?
If you were to die and then say your kids sell the properties within 2 years, I thought that's the process.
Yeah, that's a different rule altogether, though. That's a completely different rule. That's more to do with the 2-year rule afterwards for principal residence. When it comes to transferring property, as soon as you transfer properties within a family, that's not just that's a transfer. So what you're doing is you're actually transferring between family members. And it only applies to certain kind of assets. And this could get very confusing, so I don't want to get too complicated. But there's a difference between pre-1985 assets and after. There's a difference between whether the house was used as a family home or not a family home. You're talking only about a situation that's post-85 family home.
Just regarding the family trusts, if you already have a family trust in Australia, is that okay to use that, or does that separate one have to be set up?
It entirely depends. I mean, if your family trust has been sitting dormant for a while and is all looking good, probably, no problem. If you use it currently to run a business, definitely not. Why is that, everyone? Let's say that, what's your name, sorry?
Steve.
Steve. Let's say Steve's running a business. Why would he not use that same trust to buy his US properties or hold his LLC? Anyone know?
If his family trust gets sued, he's probably liable as well.
That's right. So let's just say that Steve has a family trust that runs a business that owns his LLC shares, gets sued in the business, all the assets of that trust will get taken by the liquidator or the bailiff. That will include the shares in the LLC. You've lost your LLC. That's all that goes as well. If you're using it for if you're using the trust in Australia just to buy, say, Australian property, same deal. I still wouldn't do it because if you get sued as a landlord in Australia, you won't just lose your Australian properties, you lose your US as well. However, if your Australian trust only basically is a shareholding type trust, so it only owns shares in, say, businesses or invests in shares or trades, that would be fine. So it entirely depends on your trust is what I'm saying.
It's interesting because it did own a business which is now sold.
Yeah.
And has quite a large bill to the taxation department.
Okay.
Different again.
Yeah. That's what I'm saying. It's very specific. The general rule is you don't just go and use your existing trust without really making sure.
I think you may have already answered this question, but if you've already got a family trust, why can't you just buy the property in the family trust name without the LLC?
Yeah, I mean, generally, the preferred way, you can technically do it in terms of going through that. The preferred way is generally to buy it through a US structure, is what we're pretty much recommending. But you can technically do it, but it's not the best way.
Okay.
What if you purchase more than one property? Do you need separate trusts set up, separate LLCs for every separate purchase?
I think the guys are covering that tomorrow.
Okay.
My understanding is generally what's being advised is yes, to have separate LLCs per property. That's my understanding. But I think that's been covered tomorrow. In Australia, by the way, I don't normally go at extreme, but US, from what I know, we're being a lot more litigious and a few other things, and different states having different rules. My understanding is generally that's the preferred way.
If I don't currently have a trust set up in Australia, but I set up an LLC here and then just have it pay back to myself as an individual, is there a lot of paperwork to switch it over to a trust, the LLC pay into the trust later?
You have to probably fill out forms in the US to ever set up the LLC for you and change the individual name to a trust. So you have to go through all that sort of later on. But I normally don't recommend that you do that. You should basically set it up right from the beginning.
So just to make this very clear.
Yes.
So I've got, because at the moment we've got a small business, family business, that is set up as a unit trust.
Yep.
And then it's passed down to a family investment company, which is then owned by the family trust, the family trust. Do you understand that multi-layer thing that you guys have set up?
It's just getting a bit...
Yeah, so for that, if I get a US property, set up a separate company, can that still act as trustee for the family trust, or are you saying to set up a separate family trust?
Yeah, I mean, the general rule is, just to make that more relevant to everyone, is if you've already got a company as trustee for a trust, existing trust, it depends on what the company's doing. If the company in Australia is basically holding other properties, for example, and then also as trustee, I generally say no, it's not a good idea, as a rule. It's a bit the same that situation. The general rule is you really should be setting up a whole new trust, unless the Australian trust, for example, is specifically like a very low risk type of activity, like just hold shares, an equivalent type of trust. But setting up using the same trustee in both situations across jurisdictions I don't really like it. I like to keep things pretty simple, and it generally works a lot better.
With regards to the family trust and LLCs, yesterday when we were setting up the bank account details, I asked specifically whether to set up the bank account in my name or the family trust, and they said in my name. Do you agree with that or not?
So if the bank account, I think the first bank account, you're just getting yourself set up. I mean, I've done the same thing. But you will need to, once you get your LLC set up, there's a separate process, isn't there? Yeah, completely separate process.
Okay.
Yep, so thanks. There's one more question over here.
More of a practical question. If I don't have any structure in place and I want to buy a property at the end of this week, how quickly can that move to get a structure in place?
Okay,
exactly
that's
as
been
you
covered
mentioned?
tomorrow. There's guys going to be here speaking tomorrow and getting that set up for you. And from what I understand, they can do it like within a day.
Okay, great.
Like very fast.
Just a tail end to that. Would then if I take financing, would then the financing be in the name of the individual myself or in the name of the structured entities?
In terms of your personal finance?
Yeah, if I'm purchasing this property.
Look, again, that's probably more question to ask Goro, who spoke before me.
Okay.
But the general rule is anyway, from what Goro was saying, is that you can't basically get US finance anyway over US companies. So you'd be getting the finance in your personal name. That's basically how it works. Unless you're getting specific US finance, but from what Goro was saying, banks are not doing that for you right now. Okay. So we've covered pretty much how you structure, presuming you're not in super. We've covered that now. We've covered basically how tax works. Has everyone got at least a little bit of a grasp of all it works now? Okay, now we're going to be covering superannuation, and there's a lot of hands that went up, so I'll tend to cover this quite thoroughly. So presuming all of you are talking about self-managed fund, who plans to use super and has got a self-managed fund set up? Put your hand up. Quite a few of you. Who plans to do it through super and does not? Okay, quite a few as well. Okay, so let's just go through the process, how this works. The beauty with super, of course, while you're doing it, is you only pay 15% tax up till age 55 or 60, and after age 60 you pay 0% tax. So super is a great vehicle to be doing this, a really good vehicle. So you want to be basically buying property. If you're going to be doing this and building up your super wealth, it's a great vehicle because the taxes are really low. It's a long-term strategy. The chances are you won't want to be selling properties for a long time. It's a great vehicle to do it. Now, the simple rule is you can definitely buy property in a self-managed fund. The problem in the past has been borrowing. Up until 2007, you could not borrow in a super fund to basically buy property at all. Now you can only borrow in limited circumstances. Now it's important to know is even though most of you won't be borrowing in the US to do this, let's just say that you're going to be borrowing in your personal name or whatever else to do this, well, there's just a few nuances or complications you've got to be aware about with super. So what can you do in a self-managed fund? You can buy property, you can borrow to do so in limited circumstances. Now, the biggest thing here is just what's called this bare trust rule. I'm going to actually draw a diagram to explain this, okay? This bare trust. Because up until 2007, you could not borrow to buy property, period. You can now. But it's a little bit bewildering how it works. And why they did it this way, I don't really know to this day, but they did. Let's say you've got a self-managed fund set up. Let's say it's planning to buy a property and borrow to do it. So let's just say it's 60 grand property and it wants to borrow 40k. The super fund cannot actually borrow the money at all. However, it can do this. It can set up a bare trustee. Now, a US property, the bare trustee will be the LLC, and the beauty of LLCs is that that will act as a bare trustee. So that buys the property and owns the contract or title to that property. But I'll explain what a bare trust is. A bare trust is a very powerful little weapon in commercial terms. A bare trust means that although it's a trust, the trust only exists solely for the purpose of eventually giving it to one beneficiary. So, for example, I'll tell you where bare trust is used very powerfully to make it simple for you. Let's just say that I wanted to buy my next door neighbour's property, okay? My next door neighbour loathes me. He hates me with a passion. He wouldn't sell his property to me if I was the last person on earth. If I offered him twice the value, he still wouldn't sell me his property. Let's say that was the situation. This is what I can do. I set up a company called something completely unrelated to me, like Ocean Investments, for example. I then go to a friend, like say I go to Paul here, and I ask him, and I say, Paul, I want to buy this property. So Paul then goes, and he owns the company, and he buys the property in his company name with my neighbour. But we have a bare trust agreement in place that says that Paul acknowledges that he's only ever buying this property for me on trust. As soon as the settlement goes through, he acknowledges upon my demand, within 21 days, he must transfer the property to me and fill out and sign all the relevant transfer forms. Paul then goes and buys the property for my next door neighbour. The next day, I exercise notice upon Paul. He then gives it to me, and I know on the property, and next door neighbours have sold me his property without realising he's just done so. Who thinks that's quite clever? No, bare trust is no stamp duty. So it's quite clever. It's also done a lot in commercial acquisition. So let's just say that I'm going to take over another accounting firm, and they wouldn't sell to me because they don't want me to get too much market share. I then go and get, say, another friend, like get Steve here. We set up a company to Steve. Steve then goes and negotiates to buy the accounting firm. As soon as he gets here, he gives it to me. I now have taken market share. Who thinks it's quite clever? Yeah. Now, that's a bare trust. That's exactly the same principle here. So the US LLC buys the property, but only ever on the intention it belongs to the super fund. So why on earth they've done that with the law, I'm to this day bewildered. I have not worked out why they've done that, but that's how it works. It makes it very expensive to buy a property with all the legals involved. I've just done it recently for a client at 21st Century Accounting who we just done a really big one, and it was just a nightmare because of the process. Banks are always a bit more rigmarole when these are involved. You've got to get the agreements done up, the bare trust contracts, everything done up. So the short answer, in a self-managed fund, you can buy a property in it, no problem, provided your investment strategy allows you to do so, and it should definitely do it. And you also, if you want to borrow in your fund, you have to basically use a bare trust. Now that can use problems. Let's say that you want to buy in your super fund and you're going to be borrowing in your own name as cash. Well, you effectively have to borrow and make a contribution to your fund because of this borrowing rule. So that's what you can do. So what can't you do? You can't pay remuneration to yourself from the super fund. You can't borrow without a bare trust. But here's a big one. You can't use the property for personal use. Now, get this one really clear. This is the Swiss Chalet case, a tribunal case 15 years ago. let's say that you end up buying a Scottsdale home here. I don't know, let's say you buy a slightly nicer one for 100 grand, and you actually do it up, decide to use it, and you're renting it out. And then what happens is there's no tenants at one stage, and you happen to be in America. So you think, oh, I may as well use the house. So you can go in and use your house for a week. You've actually just broken the law. Because you cannot use any super fund asset for personal benefit. You can't even go in for one day. If you buy a Ferrari in a super fund, you can't drive it. If you buy wine, you can't drink it. If you buy antiques, you can't look at them. If you buy paint, I'm serious. If you buy paintings, you can't hang them on your wall. It's very strict, and there's all kinds of ATO rulings on this. So when you buy US property in a super fund, period, you cannot use that property in any personal benefit at all. You can't send your wife there, your husband, your kids there, your cousins there, your dog there for a period of rest. You can't do any of that. Okay? Now, here's another one too I've got to mention too, because there's been a lot of debate on this one. Pay in own name now and transfer it into your fund later. Unfortunately, I've spent weeks with auditors on whether you can do that and trying to find ways around it. And the basic conclusion we put in is you can't. So basically buying a property in your own name now and then transferring your super fund later on, you can't do that. Because the law stops you from gifting any personal asset into your fund unless it's either shares, listed shares on the stock market, or this is what's called business real property. So unless the US property you're buying was a commercial property of some kind, which it was in some way affiliated with you in business, you can't do that. So you basically need to get your super fund set up, underway, and quick smart. So my suggestion is, if you're planning to be buying property over the next period of time, and you don't have a super fund set up, get onto it like now, okay? I'm going to be doing consults. Get onto it now. It takes about a bit of time to set one of them up. You want to get onto it now, okay? So, hang on. So basically, yeah, so short answer is if you've got a super fund now, you can buy in it now. If you don't, unfortunately, no, you don't buy it in the name of the fund where it doesn't exist. Now, what you can do is set the fund up, for example, get a deed signed, get it executed and everything like that. There is one way you can do it if you want to do it quickly, but you know, it still takes a few days. You set up a fund, you get the trust deed signed so it's in legal existence, then you might pay cash for it in your own name or whatever else, but then you make a contribution of that cash effectively into your super fund. So there is a way to do it in less than 6 weeks or so it takes to set up a fund, but it's a little bit convoluted. So I'll just explain that one so it makes sense. So let's just say you don't have a super fund, but you want to buy a super fund like pretty quickly. You can get a fund set up. There's a few processes to set it up, okay? Number one is to get the deed set up. Number two is get the ATO compliance certificate. 3 is the bank account, and 4 is the rollover. And when those 4 steps have taken place, you now have a super fund ready to go. The question I did go through the auditor was what constitutes legal existence of a super fund? So just buying a property in the name of a fund before the deed is signed, it's basically not on. Because technically you're buying in a non-existent entity. So if you then set it up later on, in his view, you're deemed to have gifted it in there, and effectively then you've broken the law of contribution. Let's say, however, you set up a super fund deed immediately and you sign the deed, let's say on the 13th of May or 14th of May 2011. If the property contract is signed and dated on the 14th of May 2011, that's actually okay, legitimate purchase in your super fund, okay? The problem is funding it because you've got no money in the fund, because you haven't actually got the bank account and the rollover and the ATO certificate. And until you get the ATO certificate, which takes 3 to 4 weeks as a rule, the super funds will not release your money to roll over into your self-managed fund, and you'll have trouble getting a bank account. But however, let's just say that you then pay for it in your own name, so you pay your 40k cash. You can do a minute up and then basically do a subsequent contribution effectively into the fund. That one I spent a fair bit of time going through. So the short answer is you can buy in a super fund, no problem. You will need to basically set it up properly and get the legal deed signed before you actually can buy in that name. But then provided you pay cash and do what's called a contribution, you're fine. Okay? Now, it's probably a bit confusing. All of you lost here, or did people follow? Followed it? Okay, great. But believe me, you want to get this right, and I'll tell you why. It's important to understand the consequences if you don't. Every year, you've got to go through an audit of your self-managed fund. Now, since 2009, auditors have been ordered by the ATO to crack down on funds, because in the past, auditors have made a general rule of what's called a rubber stamp. So auditors will look at a super fund, say, it might be a little bit funny, but they'll generally just let it go. Now the auditors are pretty much told, if you rubber stamp super funds where it was non-complying and we find you out, we'll strike you off your licence. And not just that, they actually now do spot checks on auditors. If an auditor's always approving funds of no qualified reports, they actually will often go and audit that super fund auditor. So auditors know, but they've got to make sure that if there's any breaches, they've got to report it. Okay? So I'll show you an example of what could be a breach here, and which you can do. Let's just say that you actually go ahead, let's say, you pay some money or whatever else, and the fund isn't even set up as yet then. Or let's just say that you pay some money, you haven't actually signed the deed, then signed the deed, or something like that. That's actually, that will be reported as a breach or whatever else for the fund. And once it's reported as a breach, the ATO, you put it in the report, and the ATO get a report saying that this fund is in breach. Now, in practice, understand this. The ATO are very lenient on first breaches. I've never seen them do a penalty for inadvertent breach. So you can relax to that. Not saying they won't start, I've never to this day seen them do one. But you don't really want to be breaching in your super fund to start off with. So what happens is you get your tax return done and get your audit done. If there's a breach, you get what's called a qualified report on your fund, okay? So everyone pretty clear on that? So when you're buying a super fund, be extra careful to get it right, okay? Because I can tell you now, anyone been through a super fund audit when they bought property? Yeah. The auditor wants to see everything. You found that, Michelle? Everything. They want to see your trust deed. They want to see your risk management statements. They want to see a copy of the contract. They want to see everything. And they will audit it thoroughly. So with a super fund, think of it like you go through a tax audit every year. Imagine going through a tax audit every year with your personal or business. Anyone say yes? No. I mean, obviously we don't want that. But the super fund, you effectively have a tax audit every year in your fund. Okay? So just keep that in mind that when you're buying property, get it right. If you've got a deed set up and you're not 100% sure it's set up properly, check it out. Because the auditor will basically find out if it's not. And believe me, we were pretty good at getting auditors to overlook things. You know, we would look at auditors and could talk them around. We can't now. Auditors are just, they're too strict because they don't want to lose their licence and lose their livelihood, and they do. The ATO have told auditors, if you're basically rubber stamping funds or putting things through where there's clear breaches, we're basically, and we find you doing it, we'll basically strike you off and remove your licence as an auditor. So, rules in summary here. You can definitely buy US property direct in your super fund. Best to use the LLC and make sure it's a bare trust arrangement. So even if you're not borrowing, what I'm recommending is set up the LLC, but here it's very important how you set your LLC up. Remember I told you that you own your LLC through a family trust normally? Not in a self-managed super fund. The members of the fund have to own the LLC. So let's just say that you're planning to buy a property in a US self-managed fund, okay? Or a self-managed fund, sorry, in Australia. What we're recommending you do is this. You set up a US LLC. Let's say it is husband and wife, just to keep it simple, members of a self-managed fund. Husband and wife should be the directors and the shareholders of the LLC. And then it has a bare trust arrangement with the self-managed super fund. If you do that, you're not going to have any problems with the auditor whatsoever. I sat down with a fairly conservative auditor, went through that with them, spoken to 2 auditors, no problem. One auditor said, yep, no problem. Another one said, yeah, it's an overkill. So if anything, it's over-conservative, but other auditors have told me other ways. They said, no, they don't believe it's doing it. Any other ways of doing it, like owning through a family trust, you get mixed opinions. So my view with super is take the cautious approach. There's not really much difference to do that and do it properly. So if you're going to be doing it, if you write that diagram down in that structure and you follow that, you'll be fine. Okay? Yeah. If you're single with a self-managed fund, by the way, you have to have a corporate trustee because you can't have a one-member super fund unless you've got that. So if you've got a one-member, if you're single and you've got your own super fund, you would have a corporate trustee in Australia over here, which would be, you'd be a director and shareholder, and then you'd be the sole member of the fund. And then that over there, you'd be the director and shareholder of the US LLC. So a little bit of rigmarole, but that's just basically, if you do it that way, you can buy in super and you won't have any problems. But I've just seen a few different examples, encounters of clients who, without actually seeing us, have gone and done different things, then come to try and fix it up, and we've been like, oh dear, you see that ways that have been done that just don't qualify. So moving forward, there's going to be a lot more US investing happening from, obviously, from the academy and from everywhere else. Basically follow this right now and you'll be fine. Conservative way of doing it, but from what I can see, there's not going to be any hassles. Okay, things to watch, a couple of things to watch here. The property contract must be in the LLC name, okay? Must be. Not the super fund name. Very, very important. It must be in that name. And to make it more confusing and a lot of fun, the rent doesn't get paid to the bare trustee, it gets paid direct to the fund, as a rule. That's basically the general rule. Now, if it's a US LLC, it probably will go to that bare trustee in practice, but the general rule of a bare trust in Australia is it gets paid to the fund. Now, with the US LLC, in practice, the manager will be paying it direct to the LLC, but on behalf of the super fund. And I mentioned here, auditors are absolutely anal. Gestapo trained, as I put it. So what do you need to use a super fund? Well, what are the things you're going to have practically, okay? Okay, you've got to make sure you've got a super fund trustee and signed. Make sure it's properly signed. Make sure your folder's got all its minutes in place. Check with your accountant and whatever, it's us, whoever. Make sure your investment strategy allows you to do it and that you have one, okay? You should have one automatically set up with any super fund. I mean, we do it automatically. But make sure your investment strategy, any risk management statements allow you to do it. Make sure you've got your ATO compliance certificate, which you would have had by now if you have already set one up. And once you've done all that, just lodge your tax returns and get your fund audited. But the main thing is having the right documentation to go ahead and do it. So practically, what's the name that you put, for example? Well, the name of you're going to be putting on the contract, let's just say that your name is Joe Bloggs, and you've got the Joe Bloggs Super Fund. You've got two effective entities happening over here. Your LLC might be called, and naming your LLC is also going to be fun. I generally say keep it fairly simple. The guys who are speaking tomorrow on it, I know I've got their different ways of doing it, and we were talking. My rule is keep it simple, make it descriptive. Like let's say you've got Joe Bloggs. You might have the Joe Bloggs, and you make it long to make sure it's unlikely and make it quick. If you want it set up quickly this week, your LLC, you want to make sure it's a long name unlikely to have been taken. So you might set up the Joe Bloggs Phoenix, Arizona Property LLC number 1, for example. And then if you set up another one, the number 2. And then you have a list as to what number 1, number 2 represent. So something that's descriptive, self-explanatory, very simple. If you know what property you're even going to buy, I know in the past I've had clients who just bought the, say, Johnson Road Scottsdale property, for example. But you generally won't know in advance when you set your LLC up. Now, if you set up a self-managed fund, your self-managed super fund name will look something like this. J Bloggs, and let's say he's married, and say E Bloggs. As trustee for the Bloggs Super Fund. So J Bloggs and E Bloggs, or if it's a corporate trustee, Bloggs Proprietary Limited as trustee for the Bloggs Super Fund. So the name you'll be buying your property in will be obviously that name over there. And that will hold it in bare trust for this over here. Are you all following that? So I'm trying to make this quite simple and practical because I know this is where people get really lost. Is this helping? Yep. Okay. So, summary. buy in your LLC, own it in an individual name or family trust, but better in a family trust to protect your assets in every sense of the word. You can buy in a self-managed super fund, but be very careful how you structure the arrangement. Now, actually, I've gone through this. I went the wrong way. So, before I move forward and finish up here, I'm going to open up some questions on, obviously there'll be a few, I'd imagine, here. Okay.
Just in question about setting up a super fund, is there much fees and charges you actually need to pay by doing it yourself? Like to actually set up, do you need to...
There's a cost to set one up initially. Yep. Then after that, every year, there is costs you've got to pay each year. You're going to have to allow about, I normally say at least $3,000 a year in tax return and auditing costs. I say if you allow about $3,000 at least. If you're buying a lot of properties, you probably should start allowing about $5,000. Especially your first year's audit is always going to be a bit more involved because the auditor's going to want to see all your documentation. Once you've done one audit, they're generally a little bit kinder on you.
And if you keep adding stuff to your super fund, you put the charges on top of that?
Keep adding stuff in terms of?
Yeah, I was told by someone that if you do lots of share trading, because you're actually doing share trading, you're actually putting more money into it.
But share trading is quite involved, and the auditor's got to go through it thoroughly. So when you do share trading, your audit costs go. I've seen people who do lots of share trading end up paying $6-7 grand by the time they're finished.
It's something like per transaction or something like that, isn't it?
Not quite, but it's just a lot more work. Paul's next. Just give it to Paul. Next to you.
If you're buying a number of properties, in your self-managed super fund, do you need to set up an LLC for each property, or can you put more properties in one LLC?
Yeah, we were discussing that before. Someone asked that before, and I mentioned that the guys tomorrow are talking more about that. My understanding is that they're pretty much saying you need to buy a different LLC per property, is my understanding of what's being said.
Okay.
Okay, Mike.
Just with the personally borrowing in your own name but using the bare trust arrangement, how does that work for security of the loan?
How do you what say?
So if you're borrowing in your own name,
Yep.
usually the security is the property,
Correct.
which is also in your own name.
Yep.
And if the property is now in the name of...
Bare trustee.
Yeah.
That's fine. Yeah, the banks will do it. They'll take security over the bare trustee. The reason why they got the bare trustee is because you can't take security over a super fund charge. So if the bare trustee does it, you can do it. So the banks will do it, but the way we've structured the loan is in your name, but the security is over the bare trustee company.
If you are buying in the name of the super fund and you are setting up an LLC, what's the tax rate if I have a super fund in Australia which is in pension phase, therefore...
It's still the same rates, nothing changes. The LLC is only holding it as bare trustee. So the super fund is only holding the bare trustee only holds it for the super fund. So whatever the normal tax rates are for a super fund, that's what they are.
So over here you won't be paying any tax?
No. No, you'll be paying, if you're in pension phase over 60, is that right?
That's right.
Yeah, well, you won't pay tax, no.
So I won't have to pay tax here either?
No. Assuming you're in pension phase over 60, yes. Anyone else? Okay, so I hope you've all got something out of that. Everyone learnt something? This stuff is critically important. So in summary, I just want to highlight the main salient points I've been saying here. Number one is you really, 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 really want to get your assets, make sure your wealth is properly insured. If it's not insured, you've got some assets, get it fixed up, serious. Don't delay. Especially while you're here now, we're here, we're in the moment right now. I'm going to be going through some appointments shortly. Get onto it, get it fixed up. Because otherwise these things get lost, you can move on with life, and then one day you wake up, you've got that dreaded letter in the mail, and it's on for young and old. So that's the biggest thing, is your protection. Number two is structuring yourself correctly. I've gone through about my recommendations about owning your US property in the LLC and having a family trust in Australia be the shareholder of the LLC. I've gone through some practicalities as to how you can be the shareholding and how you can own it for an Australian company and have a trust minute to do that. I've looked at wills as well, for making sure your succession planning is all properly done in Australia and US in doing this. And I've gone through, very importantly, super funds and saying if you're going to be buying through a super fund, be very clear to structure this properly and be precise in how you do this. Okay, so it's just moving forward. So how can I basically help you moving forward and serve you and what you were doing to make sure that this weekend you get out there and make this happen? Look, obviously it's a specialist area, and I think it goes without saying that you really want to be speaking to advisors who know what's going on with US property in Australia, who basically have got the multi-jurisdiction. You'll find very few advisors in Australia actually touch both jurisdictions. There are ones who do it, but certainly you want to make sure they know this. What I'm actually doing is, because there's a lot of people here, making myself available for a quick free 10-minute interview, 10, 15 minutes or so, which means what that will mean is come and have a chat to me, and I can have a quick assessment of your situation and tell you what I see you need to do and how we can help you. If we can't help you, that's fine. If we can help you, then we'll tell you what's involved. So if you know who here is, for example, particularly would love to get something happening with super. Yeah, I mean, come and have a chat to me. We can get something happening with super. Who here knows at least they've got to address their succession planning issues, like their wills, things like that? Yep, come and book in there for one of the interviews with me. And also, and there's various advice strategy packages that we're offering here where we can go through, tailor your situation and come up with proper advice. So we can set up your structures for you, self-managed fund, get them on the way, making sure you can get involved, get this moving. We can get you advice packages happening, make sure your super fund's up and running, and especially make sure your wills and getting that on the way. Now, just write down, these are my contact details, so you can write these down. I don't normally give up my personal email, I normally get the help. I'm actually putting that there specifically because you're all here. So that's our general office number for 21st Century Accounting. That's our general help one. I might add, if you've got basic inquiries, you're generally better off to send them to the help. And the reason why is when I'm travelling and their emails get unanswered for quite a few days with me. So if it's general basic queries, you're often best to send them there. But if you've got specific queries or something involved from here, feel free to email me and I'll make sure I get back to you, okay? So, everyone got that down? Okay. Okay. Oh, you got copies of the slides already, have you? Okay. Great. Okay, so come up the back. I've got some forms here and we can book in for your interview now. And thank you very much and look forward to seeing you over the next few days.